welcome to this explainer. Today, we're jumping straight into the actual mechanics of building true wealth. Look, we're going to demystify why those early investing years feel like such an invisible, frustrating grind. You know the exact feeling I'm talking about, right? You set up your accounts, you follow all the rules, and you wait for the magic to happen, only to feel like you are literally going nowhere. Well, today, we are going to visually map out exactly what is happening right beneath the surface of your portfolio. We'll break down the true timeline of compounding and hit on the specific mathematical milestones you absolutely have to cross to reach financial freedom.
So let's just dive right into this massive question, because honestly, it hits on the deepest pain point every single new investor faces. Think about it. You do everything perfectly. You park your money in a low-cost index fund, you don't panic sell when things get choppy, you just leave it alone. And yet, when you log in to check your balance after a year or two, it feels like a literal rounding error. It's this wildly frustrating gap between the promises of compounding you read about on paper and what it actually delivers in those grueling early years.
Section 1. The Early Grind Trap.
Okay, we have to start by validating a psychological trap that honestly breaks way more investors than any market crash ever has. See, it's not the crazy volatility that gets people to quit. It's the sheer mind-numbing boredom and the perceived lack of progress. Traditional financial advice completely fails because it ignores how our brains actually work under pressure. The classic frameworks act like you're some kind of robot who makes decisions completely void of emotion and never gets frustrated by a lack of immediate reward. But hey, we're human. When your budget feels super restrictive and your investments just aren't moving the needle, the temptation to just throw in the towel or start recklessly tinkering is overwhelming. Just to put this into perspective, get a load of this staggering stat. Back in a 2019 study, Vanguard looked at investors who did everything by the book for 10 straight years. The median balance? Just $93,000. For most people, that feels like they've completely missed some secret shortcut. I mean, after an entire decade of perfect discipline, they only have about a year and a half of an average salary to show for it. But here's the thing, they didn't miss anything. The math just works fundamentally differently than what we've all been told.
Let's look at Daniel's situation as an example. When your day job is paying you 70 times more than your investments are making, the whole strategy feels completely broken. Daniel earns 62 grand a year. He maxes out his contributions, and after year one, his 8% market return generates $880. His salary is literally lapping his portfolio. And this is the exact moment where most people panic and optimize for the completely wrong variable. They start chasing higher, riskier returns, instead of realizing that the real issue is simply the size of their capital base.
Section 2. Mechanics of the curve. So how do we actually fix this engine? Well, we have to completely redefine how we think about compounding. It is not a straight line, it is a physics problem, and it relies entirely on the mass of your capital base. Think about it. A 10% return on $10,000 is just $1,000, but that exact same 10% engine running on a heavy $300,000 base, that pumps out 30 grand. It's not about finding a magic better return rate early on, it's about feeding that base until it carries enough weight to bend the curve upwards.
And to build that heavy base as fast as humanly possible, you absolutely must lock in 3 non-negotiable structural moves. First up, automation. You've got to automate your contributions so you never have to rely on sheer willpower during a bad month in the market. Second is income growth. Since your contributions are doing all the heavy lifting in the beginning, increasing your income and chucking it into the base in your 30s is infinitely more powerful than doing it in your 50s. And third, total reinvestment.
Which brings us to this mind-blowing fact. Nearly 40% of historical stock returns actually come purely from reinvested dividends. That's almost half. If you're just leaving your dividends sitting around in cash, you are effectively leaving half of your potential long-term wealth right on the table. Every single dividend payment has to be folded right back into your base so it can start earning alongside your original principal. No exceptions.
Section 3. Growth versus dividend investing. Now, as that base of yours grows, you're going to hit a literal crossroads. Do you focus on explosive tech growth, or do you shift toward reliable dividend payouts? Well, your age and your risk tolerance make this choice for you, splitting your journey into 2 distinct phases. First is the wealth-building accumulation phase, and later comes the cash flow-focused decumulation phase. When you're younger, accumulating wealth, you can totally stomach the wild roller coaster of growth stocks because you're after pure total return. But as you transition into retirement, the decumulation phase, you face sequencing risk. That's the absolute nightmare of a market crash happening right as you start withdrawing your funds. That is when you need a smooth ride, and the stability of dividend income becomes absolutely paramount. And if we actually run the numbers dating back to 1989, a really fascinating pattern emerges. The dividend aristocrats, these are companies that have increased their payouts for 25 consecutive years, actually slightly beat the S&P 500's average annual return, hitting 11.6% compared to the S&P's 10.6%. But honestly, the bigger deal is how they handle the bad times. In down months, the aristocrats outperform the S&P 500 roughly 66% of the time. You get a much smoother, crash-resistant ride, which is exactly what lets you sleep at night when you're relying on that money to actually live.
Section 4. The power of holding.
Next up, we're tackling what is arguably the hardest skill in all of investing, the art of doing absolutely nothing. Treating a high-quality stock like Broadcom or Infinal as a rare, precious possession yields mind-blowing returns, if you can just patiently hold on. I mean, look at this incredible 1,400% gain on Broadcom. Sure, the company totally evolved over the years, shifting from mobile chips to custom AI data center hardware. But as an investor, you only capture that massive, transformational upside by ignoring the short-term noise and trusting the compounding process over years, or even decades.
Because actually, if you tinker and sell, you get smacked in the face by the harsh reality of tax drag. Frequent trading is basically like trying to run a marathon in deep sand. The frictional costs will just exhaust your portfolio. Let's say you lock in a quick $1,000 profit, but you get hit with a 24% short-term tax rate. Suddenly, you're only walking away with $760. Just to get back to where you started before you sold, your next stock pick has to fundamentally outperform the market by a massive margin. Mathematically, just holding on to high-quality companies is vastly superior.
Section 5. The 2 tipping points.
And that brings us to the climax of this whole explainer, the massive mathematical payoff of extreme patience. Let's follow Sophia's timeline here, because it shows exactly when the math stops being a slow grind and starts being truly transformational. So Sophia starts at age 28, putting away $6,000 a year. It feels incredibly slow at first, but watch how that curve bends. By 42, she's sitting at around $220,000. And by age 58, 3 decades in, her portfolio crosses the $1 million mark. And get this, out of that million, she only contributed $180,000 out of her own pocket. The market provided the remaining $820,000.
But none of that happens unless you push through to tipping point 1. At this crossover point, your portfolio starts generating more in annual market gains than you are contributing from your own paycheck, completely flipping the dynamic. If you're putting in $6,000 a year and averaging a 10% return, that crossover happens at exactly $60,000. On that glorious day, a 10% return generates $6,000, perfectly matching your own labor. You are officially no longer the sole provider for your portfolio. Your money is finally pulling its own weight.
And from there, you eventually hit tipping point 2. This is the exact mathematical threshold where your portfolio completely replaces your salary and your day job officially becomes voluntary. This isn't some vague wishful dream, it is pure arithmetic. You just take your current annual salary and divide it by your expected return rate. Boom. The number you get is the exact portfolio size required to generate your living expenses entirely passively.
Depending on your personal risk tolerance, this ultimate freedom number is actually incredibly attainable for average earners. Let's look at James, a high school history teacher making $60,000 a year. If he assumes a historical 10% return, he only needs a $600,000 portfolio to make his job optional. If he wants to play it a bit safer and assume a 7% return to account for inflation, his target bumps up to $857,000. And if he goes hyper-conservative and uses the classic 4% withdrawal rule, he's aiming for $1.5 million. Whichever path you choose, the threshold is real, it's highly specific, and most importantly, it is entirely reachable if you just stay the course.
So, as we wrap up this explainer, I want to leave you with one absolutely critical question to spark your next move. Look closely at your current setup. Do you have your automations locked in? Are you actively driving up your income? And are you automatically reinvesting every single dividend? If not, you need to fix that today. Protect the size of your base, embrace the boring early grind, and let the physics of compounding do the heavy lifting for your future. Because at the end of the day, time in the market isn't just about hoarding money, it's about buying back your ultimate freedom. Are you willing to endure the boring years to get it? Thanks so much for joining me, and I'll catch you next time.